You've got to find good operators that have established businesses that have been in place for years and years. I could even argue that maybe they've been in place for decades at this point, and make sure that they've got very strong track records doing what they are planning to do with the opportunities that you're looking at.
Welcome back to Keeping It Real Estate. I'm your co-host, Dan Breezy, and today we have Randy Smith joining us on the show. Randy is the founder of Impact Equity, and after 25 years in sales, Randy turned to passive real estate investing following a career setback. And he has since helped over 100 investors place more than $12 million in real estate opportunities. With that said, Randy, welcome to the show.
Yeah, Dan, thanks so much for having me. Excited to continue our conversation.
Yeah, maybe you could start out by telling us a little bit about your background and how you got involved in real estate. I want to hear about the career setback and kind of what happened.
Yeah, absolutely. So, it's not a story that's all too unfamiliar with a lot of folks. I was a seasoned salesperson. I actually did very, very well in my career for about 25 years. The last 10 or so years, I did very well financially, won all the awards and got all the accolades and leadership accomplishments. And I actually got to a point where I had started maxing out my 401ks and my IRAs and my wife's as well. So we started looking at other places where we could put our capital. And real estate was something that was kind of near and dear to me. My dad actually had, I think he owned about 100 doors in Los Angeles County back in the 70s and 80s. So I always knew I was going to own real estate someday. I just didn't know when that was going to be. So I think it was probably 2015 or 16, I started really digging into real estate, listening to podcasts, reading all the books, and then finally pulled the trigger and started buying single family homes out of state. And very, very quickly found that single family was not going to be my path to fortune and wealth. So I started looking bigger like a lot of people do. And that's when I started passively investing in multifamily. So that was kind of the start of it.
Got it. So you're working away, kicking some butt in sales, needing a place to store capital. 2015, 2016, you start doing single families. What out of state purchases did you make? I mean, where were you buying? Just high level.
Yeah. So I ended up, my first purchases were in Kansas City, Missouri. And there was a very detailed scientific approach to why I chose Kansas City. And it very specifically was, I was listening to a podcast and I decided to invest in a guy that I heard there. Like literally that was the extent of my due diligence on those first couple of houses that I bought. So we bought some turnkey rentals in Kansas City, had what I would say is a negative experience, to say very nicely. And we decided we wanted to be in a little bit more control of that. So we started doing the BRRRR strategy in Atlanta, where we bought a handful of other properties. And COVID hit, and that's kind of what put the brakes on the single family journey.
Wow. Okay. So COVID hits, you have a negative experience in single family. You're doing the BRRRR strategy. What steps did you take to start to buy or invest into larger apartment complexes?
At first, I thought I was going to jump into multifamily as a direct operator. And I started looking at, in Atlanta, I think I looked at a 12 or a 14 unit. And I think at that time it was about right around $1 million, maybe 1.2. And I didn't know a lot about the syndication space or passive investing at the time. And, we walked the property and went and saw it with a broker. And kind of last minute, we decided to back out of that. It just scared me. You make a mistake with a $100,000 investment on a single family home. It's very, very different than, buying $1 million or $1.2 million apartment. So I kind of pulled back at that point and went back to my normal education sources, which were podcasts and books. And that's where I found the syndication space and decided to start placing some capital there. At first, I was doing it to learn multifamily, to see if I wanted to actually jump in as an operator as multifamily, but found out pretty quickly that these guys had built very large organizations that were geared around these operations. And currently being employed in the W-2, I didn't have the bandwidth or the wherewithal or the expertise or desire really to build a big business on the side.
Yeah, understood. So fast forward, all of a sudden, here you are, a limited partner in 25 deals. From the process of not investing into any apartments to being a limited partner in 25 deals, how did you do that? I mean, it's a relatively short period of time.
I think in the first couple of years, I probably invested in 10 or 12 deals. And that's, at first I was just investing with operators that I found on podcasts. So a lot of the big names that everybody knows that we don't even have to say here. But then I found a local operator here in Phoenix that was doing Class B value add, which was right up my alley. I really liked the quick turns that a lot of people were seeing at the time. And I think within that 2-year period, I was in 10 or 12 deals. And by the time I actually ended up getting laid off in June of 2022, a large portion of my monthly expenses were covered by my passive income. So that gave me kind of the runway to go all in and go even deeper in this space, which I've done. So now, as you mentioned, I'm in 25 deals as a LP across I think it's 7 different asset classes and 11 different operators. So I believe in diversification in this space, definitely.
Got it. So you have a wealth of knowledge being a limited partner. You're seeing a lot of different operators in different markets. What would be a few of the biggest pieces of advice you could give to investors who are looking to be passive investors, limited partners? What have you found to be the biggest reasons or results of success for what you've done so far?
Yeah, I think it's important that the due diligence process is extremely important. So at the end of the day, you're betting on the jockey. You've got to find good operators that have established businesses that have been in place for years and years. I could even argue that maybe they've been in place for decades at this point, and make sure that they've got very strong track records doing what they are planning to do with the opportunities that you're looking at. So I think that's first and foremost, is just having a very thorough due diligence process. But then also, I think diversification is really important. So don't write a bunch of big checks to your first passive investment, because I guarantee you, within 6 to 9 months to a year, the amount of education and learning that you're going to have during that period, you're going to wish you had those dollars to spread around to other operators. So I'm a big fan of investing in minimums. And spreading around a lot of deals and a lot of operators and even asset classes and business models to get true diversification in the passive investment space.
Got it. Well, good stuff. So when you say DD process too, I just want to clarify for our listeners, you're talking about a due diligence process on general partners, not necessarily due diligence on the asset, correct?
So I would actually say it's a little bit of both. You need to get very, very comfortable with the operator, because that is ultimately who you're investing in. But there are a lot of operators out there that I will say that you would assume they're all underwritten the same and they're all the same quality of investments. But my experience has shown me that even good operators have good and bad deals. So it's important to do your due diligence on the deal as well.
Yeah. What would be some ways that you found to, execute a thorough due diligence on an operator? What are some things that have been the standout trademarks of, now I can say I feel confident, I know this person very well, I like them, I trust them?
Yeah, so it's evolved quite a bit. Early on, it very much was, gut feel, spending time, go out to Google, ask what are the top 100 questions you should ask a syndicator before investing with them. And, you'll by just simply having an interaction with an operator, you're going to get a feel for them as an individual. But as my due diligence process has really been refined over time, I really dig into underwriting models. I want to get a good understanding of what assumptions are going into the model to drive the returns. What the new guy doesn't realize is that by simply changing the exit cap rate, that can have a very, very dramatic impact on the returns of the investment. And underwriting models can be manipulated in a way to make the returns look very good, even though the deal might not be as strong as you would believe it to be. So looking at entry and exit cap rates are important, making sure that the debt that is being put on the deal matches the business model. So, don't have floating rate debt with a fixed rate cap if it's a long-term hold, like get long-term debt in those situations. So those are really important things. Looking at the assumptions of the way that the taxes are calculated or estimated, the way the insurance is calculated or estimated is really important. A lot of times you'll see, I apologize, that I've got like 100-point checklist that I go through on my deals when I do my due diligence. So narrowing it down to the top few is kind of difficult, but just really digging into those assumptions. So if somebody's planning on renovating 100% of these rooms over the course of 3 years and they have occupancy rates in the 95 percentile, like that math just doesn't work, because just by the design of having to have those units offline to do the renovations, you're going to drive some occupancy issues there. So there's a number of different things you got to dig into, but I think it's important for investors not to get too overwhelmed with the process. And if you're truly diversifying, that any one investment is not going to make you rich and it's not going to make you poor. So spreading those dollars around takes that risk off of any one asset or operator.
I think that's great advice. And I love to, Randy, that you talk about on your first deal, go with a minimum. Go with minimum in your first 5 deals. And in the future, you're going to know more. There's going to be other deals. There's always another deal coming. And, you'll be ready and wanting those dollars for that time as well. So that's some great advice there. And I appreciate, too, the talk of, learning about cap rates. A lot of passive investors probably aren't digging into underwriting models. And if you are able to dig into an underwriting model and double check the general partner's, underwriting, you're probably a more sophisticated investor with more experience. But if you're not that, that's where getting to know your general partnership team, their history, the track record, hopefully that will be enough. And if you want to learn more about that, I would get with your general partner and ask them, hey, can you help me understand how you created your exit cap rate? How did you project your rent growth? How did you project your expense growth? And your talk about taxes and insurance, critical. Those numbers are huge. What is coming? It's always, if you know what's coming and you're underwriting accurately before you close, whether it's future expenses, future income, future CapEx, you'll be just fine. It's when you don't know what you don't know and you put something on a spreadsheet that's wrong and your projections are way off. So great advice there, Randy.
Yeah. Thank you.
Well, let's just say your first multifamily deal. What was it? What size was it? Was it a limited partner? Did you raise capital right out of the gate, or what was that first deal like for you?
Yeah, so my first investment was actually a mobile home fund. So early on, I was investing in funds because honestly, I didn't really even know the difference. I understood, theoretically what the difference was, but I didn't really understand kind of the impacts to the investment portfolio. But one of the benefits of that fund model is that you get diversification, albeit within one operator and generally one asset class, but you get diversification across asset or across projects at least. So my first multifamily investment was a fund as well. And oddly enough, that particular investment has recently had a capital call. They paused distributions about a year ago, and it looks like it's going to be kind of a hard climb out of this one because they had floating rate debt. So it wasn't really until I started investing in single asset syndications like you offer, Dan, and so many others do, where I really started to get into the details of the individual assets. And you truly are, you have the ability of doing your due diligence on the asset at that point. So the first one that I invested was here in Phoenix. It was in North Phoenix. And again, it was a large operator who had been expanding very, very quickly. I think I invested $25,000 or $50,000 in that investment. And he was able to go full cycle in 14 months and almost double my returns. So very, very good returns on that first investment, which got me even more excited about the space. And what I can share is that is not the environment today, and to expect returns to occur in less than probably 3 or 4 years, I think is probably unreasonable. But it sure was exciting when I got that first big check off of that first passive investment, and a hell of a lot easier than all the blood, sweat, and tears I had put into those burrs out in Atlanta. So.
Yeah, it's a time that was interesting. We talk about a lot on this podcast of 2021 into early 22, where things were going bananas and you were getting 12-month turns on real estate, or 18 months or 24, and just doubling and tripling money, which was not normal. It's not a normal phase of the cycle. The cycle was peaking and ending, and now we're seeing this reset happen, right? Interest rates starting to rise or have risen dramatically, and then cap rates to follow, values coming down, a lot of bridge debt, short-term debt with some challenged properties. And with where we are now, Randy, what do you see coming the next 12 to 24 months? What's your projection of where things go from here?
Yeah, I mean, ultimately, we're in acquisition mode at this point. The market looks better from an investment standpoint than it has for probably 2.5 years. And the saying, like, when other people are greedy, be fearful, and when other people are fearful, be greedy. People are afraid today. So now I believe is the time to be putting dollars in this space, because we're likely going to see interest rates start to come down, which is going to compress cap rates again and drive the value of these assets up. So it's not going to be anywhere near what we saw back in 19, 20, 21. But this is truly a time to get in and be able to take advantage of all of the benefits that come with multifamily investing. So
yeah, we're in the same boat there as what you're talking about, Randy. We're just closing on a deal here now, and ideally putting one more to bed before year end. And one thing that I think is super powerful and has been so transparent for us, having a front row seat managing 17, 18 different assets across the country, is the cycle of real estate is so powerful. It is the decider. It is everything. And you as a general partner, as your syndication lead, have to have an understanding of where you are about in the real estate cycle. And when you know about where you are, and I'm not going to say you're going to know exact, like when was the bottom in, when was the top in exact, you're not going to know that before it happens, likely, right? You're guesstimating, but you know about where you are. And with what we're seeing right now with jobs reports and the economy and the slowdown and overall recession talk is likely, and we're seeing it at some of our properties. You've got folks that are just having more challenges. And with that being said, the slowdown in the economy is likely to have interest rates come down sometime in the next 6 to 12 months. To what extent, it's unknown, but cap rates generally follow interest rates. So I'm in the same boat as you, is get clear. I love the way you're talking, Randy, in the sense of get clear on your debt and your business plan, where you are in the cycle about, match that up, don't over leverage, and, focus on the fundamentals of multifamily, which is what it was founded on in our book, in my book. So it's good stuff.
No, I can't agree more. I think, and, from the passive investor standpoint, if you get in this cadence where you're putting, almost leveraging the dollar cost averaging strategy, where you're putting dollars into these types of investments consistently over the course of a 3 to 5 year time period, once you get that first full 5 cycle deal, I mean, mathematically, 1/5 of your deals are likely going to go full cycle every single year. So if you've got, $200,000 at play, that means 40,000 is going full cycle every single year. If you got $1 million at play, that means a couple $100,000 will start to go full cycle every year. So you can create this tool that spits off very, very attractive income and tax advantaged income on the back end after you invest consistently over a number of years. So that's been the strategy my wife and I have implemented, and what I really encourage my investors to do as well. So
yeah, that's such good information. So since founding Impact Equity, you've placed 12 million of investors' capital, which is a significant chunk of change. What type of deals are you bringing to these investors? Are they 100 units, 200 units, A, B, C class product? What's the typical hold time? What are some of the average returns that are projected? Just a little bit more information about what types of deals you're showing to your investors.
Yeah, so kind of starting from the top, ultimately the operators that I choose to work with are groups that are well established, well organized, well capitalized groups that have the systems and tools and teams in place to manage these assets for the long run. So I'm generally looking for institutions that either have between 100 and call it 500 million in assets under management. They may or may not have property management in-house. Generally, they are managing the construction process. And I like the Class B value add space in the multifamily syndication space. So we're looking, when we first started, we were looking in the 70s and 80s. But now we're fortunately, with the way the market's shifting, we're looking at 80s, 90s, and 2000s vintage assets. So even on the 2000s that are 20 plus years old, there's a value add strategy that you can implement into those. So when you combine the benefits of the value add strategy with newer assets and good debt, then you're going to be able to create, I won't say that it's guaranteed returns, but more predictable returns than when you're playing in the Class C or B minus even level. So, general returns, the general performer you see is doubling your investor capital every, call it 4 to 6 years. Average hold time is about 5 years. And I'm looking for projects that are kicking off cash flow on day one. So we are not getting into those situations where you've got, sub 1.0 DSCRs that just aren't sustainable if things were to get difficult.
Yeah, that's good stuff. And the size of the properties can be anywhere 100 to 400 unit apartment complexes is kind of typical size.
Yeah, always 100 plus. We always want to have on-site staff. I'm seeing most of the deals actually, call it 180 to 200 plus doors is really the benefits of having scale really come into play. And if you have concentration in markets as well, you can share resources across assets. So I like to see groups that have quite a bit of concentration in very small geographies. So you get your asset managers and even property managers are shared resources across properties.
Yeah. So can you discuss a particular deal that you maybe have had a challenge in, a deal that hasn't gone, as you had hoped as a general partner or a passive investor, and how has the general partnership team overcome those challenges if they were able to? Is there any good tips you could share as far as a tough deal?
Yeah, I think we had, I have one operator that I work with that has a very heavy Texas focus between Houston, San Antonio, and Dallas. And they took over a property that was from a failing syndicator who had gotten into a situation where they had to sell because they bought the wrong debt. It was floating rate debt without a cap. And they were just draining, they were draining a couple $100,000 a month on this asset. So they had to get rid of it quick. And in order to close on this asset, the operator that we were working with was going with agency debt. So it needed to be at 90% occupancy. But unfortunately, the operator who had it before stuffed this asset with just anybody that would move into these. They didn't have a good background check process. They weren't checking income verification. So essentially they hit their 90% so they can get their funding. But as soon as they took over, nobody was paying. So they had to evict a very, very large, they're evicting, call it 40% of the people that were in the units. So you go from 90% occupancy down to 60% occupancy. All of a sudden, like all hands are on deck and things are pretty scary. So this particular operator, he is based in New York. So he actually moved himself and part of his team to the property. They actually fired all of the property management team and brought in new folks and just threw a lot of resources at it to really re-tenant with the right quality tenants. So they did have to pause distributions for about, well, at this point, it's been about 4 months, but we're seeing things turn around pretty quickly, and we should see distributions resume within the next couple of months. So what initially was a very scary period, the immediate action they took to get on site and right the ship, essentially, put this thing back on a very positive trajectory and will actually probably outperform what we initially thought it would when they took over the asset.
Wow, that's a significant play there. So one of the general partnership teams or several of them moved away from New York down to the asset to help oversee and turn around the deal.
Yeah. Actually, I spoke with him yesterday. And he's set up, he's living in one of the units. And this is a B class property in in a Texas metro. So this is very, very different from where he was, but it's been a good experience, and I think it'll end up helping their entire organization by being on site and seeing everything that's going on. So.
Yeah, yeah, that's remarkable. That's a admirable, integral play of that general partner to get in there on site. Obviously, hope you never have to do that, and you can coach and lead the property management team in order to solve the problems. But if push comes to shove, enough things don't happen. You got to make that kind of decision. So that's impressive. Um, Talking a little bit about some significant trends that are happening in real estate, the investing space right now. Any trends that you've seen change over the last couple of years and how they're affecting the industry overall?
I mean, interest rates are impacting things more than anything. We saw interest rates grow faster and higher than we've ever seen in the history of recorded time on in this space. Anyways, just completely unprecedented trends there. So that's done a lot to drive different types of lending tools that are being used. People are going back to the traditional fixed rate debt over 5, 7, or 10-year term. That's probably the biggest thing that I would say has impacted this. We've seen a lot of assets that were actually performing really, really well that are just getting crushed with taxes and insurance. So that's really, really, really important to understand how those are being calculated in the models. We're seeing this new entrance in part that I'm playing in, where we're seeing groups like myself leveraging this fund of fund model where investors are getting brought to deals and getting better terms because they're working with groups like Impact Equity. So I think we're going to see more and more of that as we've seen this trend away from the co-GP model. And for the listener that's not involved in the space and doesn't know what those terms are, check out my website. We've got it all explained there. But start asking people, and definitely ask people that you're thinking about investing if they're the direct GP or if they're a fund-to-fund manager or just a capital raiser. So it's really understand where your dollars are going.
Yeah,
So.
yeah, yeah. Maybe we could dig in a little bit on the fund to fund talk. So how does that work? Let's say there's a syndication firm, they've got a deal and they're raising funds, and how would a fund to fund model look? Because in that
Yeah.
deal, they're going to create their fund to raise the equity. How do you partner with a fund to fund?
Yeah, so a fund to fund, essentially what I do, and I'll kind of walk through what this process looked like on the front end. Being in the sales profession for 25 years, I was sharing with my network about the type of investing I was doing, and everybody was asking me like, "Oh, what are you doing? How does it work? How could I get more information?" So we have been able to develop this type of business model that allows me to set up a fund. And it's just an LLC with the same SEC regulation and the same exemptions, either a 506B or 506C exemption. And we raise capital from retail investors, just like the syndicators do. But when I go to a group like Dan's, as an example, I'm bringing Dan a check for maybe $1 million, maybe $1.5 million. So Dan is excited to give me better terms than he would give the $25,000 or $50,000 investor. So my fund gets better returns because we're a single large check writer, and then I'm able to pass those returns down to my investors. Now, I do make a few dollars along the way because I don't just do this as a hobby, but at the end result, the returns are net positive to the investors, and they get the added benefit of working with a fund manager like myself who has experience in vetting deals and operators to put only the best well-vetted deals in front of my investors. So investor working with Dan has access to Dan's deal. Investor with Randy has access to 5 different operators that I work with, and I think we've done 16 projects over the last 2 years. So there's good and bad to these because there are added fees built into those, but they certainly have a place for somebody that's getting started in passive investing.
Yeah, so basically there's two main positives that I'm hearing is number one, you come in, and this is a positive for us as well. You come in with a larger check, the equity gets raised faster. There's less folks on our end to be reaching out to and raising capital from. So
Yep.
on our end, we say, hey, yeah, 1.5, we can do that for X amount and increase the returns for that chunk of cash. So that's a huge
Yep.
positive. And they're working with somebody who this is all you do. This is obsessive. This is what you're obsessively working on every day, getting to
Yep.
know folks in the industry. I'm assuming going to many networking events. You've got experience as an LP doing 25 deals. So I could see how there'd be a couple positives there. And on the end, the back end for that time and effort, you take a fee.
Yep.
Yeah.
And I mean, transparently, there are some negatives as well. And I think it's important for investors to know that, there is certainly a delay in distributions and in communications because the fund needs to wait for the distributions to hit our accounts, and we need to wait for the monthly or quarterly updates to hit our inbox before we can repurpose those and then send them out to our investors. And that also comes into play with K1s. So K1s, inevitably in this space, when they're delayed, nobody's ever excited about that, but you got an added step or an added layer when it comes to K1 delivery as well. So, and then probably the biggest negative is that an added layer, while it does provide extra protections from like an LLC standpoint, there's more LLCs involved, so there's more protections, but there's an added layer and another concern that you've got another entity involved there. So there's added risks by having another entity ultimately.
I appreciate you being transparent with those upfront challenges. A delay in distribution, what could that look like? Week, 2 weeks?
So in a perfect world, if your distribution hits my bank account that very same day, I can turn around and send it to my investor, which depending on the bank they work with, it could be 3 to 5 business days before they see it. So that's not that significant as long as it stays on cadence. K1s could take an extra 2 to 3 weeks to a month, depending on who they're working with to do their K1s. But again, at that point, your due diligence as an investor adds an added layer where you need to do due diligence on the fund manager as well, which is important because you are betting on their expertise and their professionalism. So it's important that like, and trust that fund manager too. So
and then the communication delay. I mean, really, that from my book, that sounds like, is there a synergy between the lead GP creating the monthly update and getting you a template that can go out to the investors in a timely manner? So it shouldn't be more than a day or two delay on communication, right?
Yeah, no, not at all. So,
okay.
Yep. Those can happen almost instantaneous, when you have the right tools and systems. But that actually brings another point too. Like there's a lot of fund managers out there that are onesie twosie guys. They've only done a couple and they've not built a business around it like we have, where they might not have the resources to turn those things around. Maybe they're still working a job. Maybe they, who knows, right? They don't have personnel or staff to help them with that. Just like you want an operator with a track record, you want a fund manager that's got a track record as well.
Well, super good stuff. Before we wrap up, do you have any advice for our listeners that are looking to get started with their first real estate investment? Let's just say someone's really green and would love to get into a deal. What's the best way for them to start to get deals in front of them?
Yeah, I think probably the best way is to listen to a bunch of podcasts, get on any operator that you hear, get on their distribution list, and try to get on their calendar to start having some of these conversations. You don't know what you don't know, so I would just say jump in and start asking questions. And when you're ready to pull your trigger on your first one, do the minimum, or even ask something that a lot of people don't know is you can actually ask to do half of the minimum, and sometimes some operators will allow you to do that. So, if you got $100,000, spread it around 4 different deals, just so you get access to different deals and operators, business plans, and even asset classes would be my advice.
That's some great advice. Another ask on our end to you is, what book suggestions would you have for our listeners if they wanted to learn more about, real estate investing, passive investing?
Yeah, so probably, the go-to book in the space is Brian Burke's Hands Off Investor. It's just a really great tutorial on everything you need to know to get started in passive investing. So I'd highly suggest that. As you get a little more experienced, actually Hunter Thompson has a great book on syndication. Rob Beardsley has some really good underwriting books and asset management books. So I would say Brian Burke's Hands Off Investor, though, is the best place to start.
That's great. Well, thank you, Randy, so much for coming on the show. How can our listeners get a hold of you if they'd like to reach out?
Yep. My website is impactequity.net. I spend a lot of time on LinkedIn, and I'm also a host of the Gentle Art of Crushing It podcast, where yours truly, Dan Breesy, was on or will be on just shortly. So check us out there.
Thank you so much, everyone, for tuning in to another episode of the Keeping It Real Estate Show. Please remember to leave a rating and review, as it helps us to bring on great guests, and have a great week.